Hey everyone, welcome back to the channel. Today we're going to be talking about real estate investment trusts, or REITs for short. So if you're interested in learning more about this type of investment vehicle, then this video is for you. And since this is an educational video, we ask that you support us by staying until the end. So without further ado, let's get started. Okay, so what exactly is a REIT? Well, a REIT is a company that owns and operates income-producing real estate. So instead of you having to buy and manage rental properties yourself, REITs allow you to invest your money into a company that specializes in real estate investing. And the best part is that you can do this all from the comfort of your couch through the stock market. So here's how it works. The REIT buys commercial real estate like shopping malls, office buildings, hotels, warehouses, or apartments, and rents it out to tenants. The rent that the tenants pay is what generates the income for the REIT. And once the expenses are taken care of, such as property taxes, insurance, and maintenance, the rest is distributed to the shareholders in the form of dividends. And the good thing about REITs is that they are required to distribute at least 90% of their taxable income to shareholders. That's why they are considered to be one of the best dividend-paying investments out there. Now, there are two types of REITs. The first one is called an equity REIT. And as an equity REIT investor, you're actually buying shares of the real estate. For example, if we go to Vanguard and type in the ticker symbol for Simon Property Group, which is a large equity REIT, you can see that it currently trades around $132 per share. Now, the reason why the share price is so high is because this particular REIT owns dozens of shopping malls across the United States. So when you buy one share of this REIT, you're actually buying a tiny ownership stake in all of these malls. And just like with any other stock, the value of your shares will fluctuate depending on how well the company is doing. The second type of REIT is called a mortgage REIT. And instead of owning real estate, mortgage REITs actually lend money to property owners. So for example, if someone wants to buy a property but doesn't have enough cash for a down payment, a mortgage REIT might lend them the money. And in exchange for the loan, they receive interest payments from the borrower. Mortgage REITs can also securitize their loans, which means that they can bundle them together and sell them to investors as a way to raise more capital. And this process is very similar to how mortgage-backed securities work. Alright, now that you know the difference between these two types of REITs, let's talk about the benefits of investing in them. The first benefit is that they provide a way to diversify your portfolio without having to buy actual properties. So if you don't have the time, money, or expertise to manage rental properties, then REITs may be a good alternative for you. It can help you take advantage of the real estate market without having to deal with tenants or property maintenance. Another great thing about REITs is that they are a great source of passive income. As I mentioned earlier, they are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. So if you own 100 shares of a REIT that pays a 4% dividend yield, you can expect to receive around $4 in dividends for every $100 you invested. In addition, REITs can also help you to hedge against inflation. This is because they tend to own essential properties that are in high demand, even when the economy is struggling. For example, people still need to go to work and buy groceries, even when there is a recession. So REITs can provide a more stable source of income compared to other investments. Lastly, REITs are publicly traded, which means that they are more liquid than other types of real estate investments. If you want to sell your shares, you can simply do so by placing an order on the stock market. Unlike houses or commercial properties, REITs don't have to go through a lengthy selling process. However, there are also some drawbacks to consider before investing in REITs. The first one is that their returns are heavily dependent on the overall economy. If the economy weakens, REITs may underperform compared to other investments. This is because when times are tough, companies may struggle to pay their rent, and REITs may have difficulty collecting on their loans. Another downside to consider is that REITs are very sensitive to interest rates. When interest rates rise, borrowing becomes more expensive, which can impact the profitability of REITs. Additionally, higher interest rates tend to divert investors away from REITs and towards other investments that offer a higher return. For example, if a 10-year Treasury bond starts paying 5%, it makes it harder for REITs to compete for investors' money, since they typically offer a lower return. Lastly, REITs may not be suitable for investors who are looking for long-term capital appreciation. Instead, they are best suited for those who are looking for a steady stream of income. While REIT prices do fluctuate, they tend to be more stable than other types of investments. So if you're looking for something that will generate a steady stream of income while providing some diversification to your portfolio, then REITs may be a good option for you. If you're interested in investing in REITs, there are a few ways to go about it. The first one is to buy shares of a REIT through the stock market. As I mentioned earlier, REITs are publicly traded, which means that you can buy and sell shares of them just like you would with any other stock. This is probably the easiest way to invest in REITs. You simply open up a brokerage account and start trading. Another way to invest in REITs is through a mutual fund or ETF that specializes in real estate. There are several mutual funds and ETFs that invest in REITs, which can provide you with more diversification than owning individual REIT shares. For example, the Vanguard and Schwab both offer a REIT index fund that tracks the performance of the MSCI US REIT Index. These funds invest in a wide range of REITs, which can help reduce the risk of your portfolio. Now, if you're wondering which REIT index funds are good, I personally like the Vanguard and Schwab ones because they have low fees and have performed really well over the years. Here is a chart showing the performance of both of these funds over the past 10 years. As you can see, they both have generated a total return of around 200%, which is pretty impressive. And that's because REITs tend to perform well during times of economic uncertainty. So if we zoom out to look at the data over the past 20 years, you can see that the Vanguard REIT Index fund has generated an average annual return of 11.78%, while the Schwab US REIT ETF has generated an average annual return of 12.67%. Both of these returns are higher than the S&P 500's average annual return of around 7%. Okay, so to sum everything up, REITs are a great way to invest in real estate without having to buy property. They can help you diversify your portfolio, generate passive income, and hedge against inflation. However, they are also sensitive to economic conditions and interest rates. So before investing in REITs, you should carefully consider your investment goals and risk tolerance. But if you're looking for a way to add some stability to your portfolio, then REITs may be worth considering. And that's it for this video. We hope that you enjoyed it and learned something new. If you did, please give it a thumbs up and leave us a comment below. We would love to hear what you think. If you haven't already, be sure to subscribe to our channel for more beginner-friendly investing tips. Thanks for watching, and until next time, happy investing.